Okay, let's take a look at this problem where we're dealing with accounts and notes payable for the Sean Aston Corporation. We've got some transactions that you can hear or read near the top and see as well. On September 1st, we purchased inventory from Encino Company on account for $25,000. Okay, I'll move the mouse off now so it won't get in the way. And the company records purchases gross and uses a periodic inventory system. On October 1st, they issue a $25,000 12-month 8% note to Encino in payment of the account. Also on October 1st, they borrow $25,000 from the Shore Bank by signing a 12-month, zero interest-bearing $27,000 note. All right, let's record those transactions. The first one is we purchased inventory, and they use a periodic system, which means we debit an account called purchases. Drop in $25,000 of what we purchased. Of course, the credit matches that, and the credit then would go to accounts payable. Okay, so there's the entry to record purchases. Now, on October 1st, we issue a $25,000 12-month note to Encino in payment of the account. All right, well, since we know it's in payment of the account, we know we're going to reduce accounts payable by that same $25,000, right? So we're reducing that amount there, if you will. And instead, we've signed a note. So we've essentially replaced an accounts payable with a notes payable. And that dollar amount is equal to our obligation again of $25,000. Okay, then we also borrowed $25,000 from Shore Bank. So hopefully you recognize we're going to borrow that $25,000, and that means cash increased, and we signed a note for $27,000. Okay, so what happens is essentially we need to record a discount on the note payable, because at the time that we purchased the note, or we took out the loan, if you will, we don't record any interest expense at that point, but we do record the discount, and the discount would be the difference between the amount of cash we got and the note we signed for. Okay, so we've got $2,000 and we're in balance. Now we've got to prepare some adjusting entries at the end of the period. Now it was a 12-month note, so let's just do the calculations. Well, first off, let's talk about what the adjustment is. It's a debit to interest expense, right? And it will be a credit to interest payable. So now we'll record the interest expense on the $25,000 12-month 8% note to Encino in payment on the account. Okay, so the interest amount would be equal to the $25,000 times the 8%, and we've got 12 months or 3 months out of 12 to consider, so it's 3/12. Okay, and I made one mistake. A24 needs to be A6. Okay, I pointed to the wrong one. Not A6. Why isn't it times 3/12? Okay, now I've got the right cells in there, and it's $500 is the interest expense, the 8% on the cash amount. Once we've done that, we know that the calculation would go here as interest payable. Okay, so now we've recorded the interest expense on the cash we actually received. Now we need to amortize that discount. And since it's a 12-month, we essentially can use a straight line approach to amortizing the discount. And the discount would then be equal to the full amount of the discount times 3/12, right? 1/4 of that. And so we have a $500 amount we have to take to interest expense as well. That's equal to the discount on notes payable. Okay, and there's the entries for Part B. Now let me slide a little bit. Part C says compute the total the total net liability to be reported on the December 31st balance sheet. The note payable we would have would show up at the $25,000 amount. And then we would also have interest payable to record. And I'm going to move that back. And the interest payable would be equal to what we recorded, $500. So if we sum those, we get the amount of liability related to these transactions on the balance sheet. And then if we needed to compute the total net liability to be reported on the balance sheet for the zero interest bearing note, we would show the note payable equal to the full amount we owed, which was $27,000. I slid that went off the screen a little bit just so I could get the number. And then we also have a discount. This one would say something like this: discount on note payable. Now, you're not going to see it on the screen, but it's in there, okay? Okay, and then the amount of the discount on the note would be equal to what we originally recorded as the discount, which is the $2,000, less the $500 that we amortized. So we've got a $1,500 net amount. And if we take the notes payable less the discount, if I put that formula in there right, that needs to be a minus sign, then we would get $25,500 as the net amount of our liability to be reported on the balance sheet for the zero interest bearing note. And that takes care of this problem, everyone. Thank you.